Andre, great work, buddy. Steve, thank you. David?
You're not getting rid of me. I'm sticking around. I like.
Okay,
I like David.
David's fourth interview here in F.A.C.E. So welcome back, my trading warrior brother. Looking forward to our conversation.
Can you hear me?
I can hear you, David. I could see you. First of all, I'd like to congratulate you on the new addition to your family a month or so ago. I believe you had a son, right?
Yes, my second son. Now I've got 2 girls and 2 boys.
Well, did he come out saying, "Daddy, hedge me"? Were those his hedge me our stock portfolio, protect my inheritance?
Well, hedge me from a fall because I actually delivered him.
Oh my goodness! Wow.
Yeah, my wife's a naturopathic doctor, and we have all of our births were at home. Wow. And on this occasion, the 4th occasion, she got her contractions wrong. They were 20 minutes apart before she got into the shower, and then she's in the shower. She opens the door and says, "Baby, call the midwives." I said to do that half an hour ago. What's the difference? I've had 2 contractions in the shower. You've only been in there 5 minutes. Oh, geez. So I called them, but they didn't arrive on time, so I had to deliver my baby. Yes.
What a beautiful thing to remember. Yes. Yeah. Oh, wow. All right. I would have fainted, but congratulations, David. And I want to also acknowledge that we had exchanged a few tweets, and it was after the initial break in October, and you said, I'm looking for a rally back into the 2,800 resistance level, and I know that you were getting short up there a week or so ago. Seems like it was a while ago. And God, what a great trade. No heat, immediate gratification. Closed great that day, and now here we are at some pivotal support. Do you take partial profits after being up 100 handles in S&Ps?
Yeah, as I told my the members of my site, Global Pro Traders, I post all my trades on that site, and I bought 2 puts, a March 19 and a June 19. And why so long? Because I like to give myself room. I'm not greedy. I don't use lotto puts or lotto calls. Right. So I wanted to give myself room to, in case we did get a rally and we did go to a higher high, because we'll get into this in a moment. But there are like 3 scenarios still out there. Okay. With regard to where stocks could go.
Well, great call, Dave.
Yeah, but I took my March one off when actually just yesterday, and I'm still running the June one. I actually bought a call at 26.92, I believe. Again, I don't believe in trying to catch the absolute bottom. I agree with the levels that have been provided earlier. By the way, I was listening the whole hour, and I love the dialogue, the information you guys were providing, Stylianos and Andre, and I was like dying to get in onto that. That's why I was posting my little chat messages, because I agree totally with Andre on WTI, and Stylianos is making some great points too.
Yeah.
But I see this 26.83.84 is, as I've been saying on Twitter and on my site, is a big level. Now, it's not a be-all and end-all. We could break it and go down to the 26.50s or even 26.30 and then head back up. But it is a big level because it's a confluence of fibs, and both on an intraday and closing level. So I see the opportunity for it to hold here and go higher, but it could go lower. And if it does go lower, I'll be buying another call, because my view is we're still going to get another rally. Now, with that, let's get into this, because I'm talking ahead of myself, which I always do. And hold on just a second.
A picture speaks 1,000 words.
Yes. I'm having trouble minimizing your little... Where's the...
You're trying to get to some charts.
There's a little orange arrow at the top of the platform.
God, I was using it earlier and I forget. Some guys like me can't multitask. Okay. So, as my wife keeps telling me all the time. So yeah, here's the first scenario.
My wife tells me the exact same thing, and I keep answering to her that I don't want to multitask. I want to do one thing at a time and do it well. That's my answer to her.
And I say it's the same thing, but in a different way. Yeah, honey, you may be able to multitask, but I'm able to focus better on one thing, because that means whatever I do better than you. And then she doesn't talk to me for another half an hour. But anyway, that's. But S&P, this is the first primary scenario for me, which is that we peaked at 29.41 in wave 3 from an Elliott wave perspective, and we got the wave A of the crash in October, which we talked about way back in February, Dale. So it's begun if this scenario plays out. So we went down to the 2600, which was widely called, and I was actually surprised because usually the market, tends to play with us in terms of when it sees a consensus call, it does the opposite. But it did. It hit the 2600 level. And
or
then
that number becomes meaningless. It either doesn't get there or becomes meaningless.
Or plows right through it.
Yeah.
Yes, exactly.
Yep.
So we went back up to this 28, just short of this 2820 level, and down we go again. Now, I believe that this is just wave B of B,
right?
A smaller wave B, and we're going to go back up to either 2820. My preference is for 2860 or 2890. And like Andre was pointing out, these are Fibonacci levels.
Right.
And,
that's about 78.6 up there at B?
Yes.
Okay.
76.4, yeah. And
okay.
You've got this inverted head and shoulders, and I just posted a message saying that I believe that this is going to be a false breakout. The market likes to play with us, so it'll go north of it'll break this neckline, go up, and everybody gets all excited, and we're going back to new highs. And
that's what it measures, new highs, and it won't achieve it.
And then it'll just turn around and dump to 2100. It's called a bull trap. And that's my primary scenario for what's coming. I mean, if you go back to the forecast made in February, the key issue driving this is not the trade war, is ancillary. The global market contagion, we can get through the various triggers for or catalysts for a crash. But for me, it all comes down to one thing, and we talked about this. It's falling global net liquidity.
Okay.
The Fed is now
part of it.
Reducing its balance sheet 50 billion a month, maximum QT. I saw a headline on Twitter this morning, and I've been saying it for a while myself, but the Powell will raise rates until something breaks. It's as simple as that. And that break is the stock market. So the potential catalyst for the next downturn could be the FOMC in December. It could be the buyback period in January, but there's another leg down coming. The issue we need to focus on now is where's the low here and when's the next rally? But global net liquidity is turning negative. You got the Fed is at maximum QT, talking about continuing to raise interest rates. You got the ECB saying they're going to taper QE to 0 in December with a nice little contingency factor that if the world falls apart, we'll change our minds. And the BOJ coming out saying I think it was a week or two ago, saying that QE doesn't work, basically. So they're all talking very...
hawks everywhere.
Yes, very negative.
They ate all the doves. All the doves just got gobbled up. David, do you think that I'm not sure when the Fed meeting is in December.
19th.
Could okay, so it wouldn't take that long for us to retrace back up to that level, because a lot of people are hanging their hopes on a dovish hike, that they go ahead and hike and language changes that's more conciliatory.
Yeah, there's definitely, with the speed of the way the markets, where you just look at this chart and, that's,
could be there in Thanksgiving.
Yeah, that's you got plenty of time to get back up to that 2860 level.
Because I know you were looking for a December, January timeframe culmination of this decline. Are those still your time frames? And I understand that if those are your time frames, of course you'd buy March and June because of option erosion, time decay.
Exactly. And I think that's the December, January timeframe is the trigger for the wave C down.
Okay.
Where the culmination of the crash could be February. It's going to be pretty sharp, in my opinion, but it could be February, March. Hence why I'm going out a little further on my option duration. But yes, the FOMC could be the trigger. We'll get into that in a second. You know, there's so many catalysts. Actually, we'll deal with them now. There's so many catalysts, Dale. I mean, you've got the G20 meeting coming up between the US and China, and I'll get into this when we talk about gold after stocks. But the risk is, I mean, they're doing the same thing over and over. They're talking a good game to prop up stocks, and then we get disappointed each and every time. I'm at least the market is starting to figure this out, but you know, I think gold got a pop from it yesterday when they muzzled Navarro and said that, you know, the U.S. government was talking to China at all levels, and they received a message from the Chinese on what they're willing to agree to with regard to concessions. Then I saw on tweet this morning saying that it's not going to meet Trump's primary objective, which is the, you know, termination of this "Make China Great in 2025" scenario. I just don't see how these two guys can agree. I think an agreement will be forced by a stock market crash, and I believe that China is relying on that. But that is one of the factors that could drive stocks lower on November 30th. If they come out and there's, you know, Trump goes, okay, you guys aren't willing to bend, we're going to impose 25% tariffs on all Chinese exports to the US. And China just turns around and lets the dollar yuan go to 740, 780.
That's what I was thinking, yeah. Yeah, they said, you know, they said they would not weaponize their currency, which made me think, man, are they going to weaponize it?
Well, it makes, I can't but giggle a little when I see people say, oh, China said that they're going to defend this level, and so we should believe them. Well, yeah. They also said that the rise from 624.50 on April 11, which was also the peak in gold, by the way, right, was driven by market forces. So who's to say market forces don't drive it to 740, 780?
Exactly.
You know, I mean, you can't take them at face value. The point is, if he imposes 25% tariffs on 500 billion or all of Chinese exports to the US, the only recourse really to the Chinese is to devalue the yuan. They've demonstrated that, and I think that may continue. The other factor, as you mentioned, is December 9th, the FOMC. They could raise rates. That could be another policy error. You got the buyback period, blackout period coming in January. That was the trigger for this fall. I've seen various explanations, but it was, I saw Goldman posted a tweet that was retweeted in late September, early October, saying 86% of companies are going into a blackout period in October.
And that,
and lo and behold, stocks went down. Why? Because liquidity is the only thing that matters to stocks.
That's a pearl.
It's the only thing. Stan Druckenmiller has been saying this for 40 years, 30 years. Don't want to belie his age, but yeah, it's the truth. And
Martin Zweig did too. You remember him? You're old enough to remember Martin Zweig. Yeah,
I do. Yeah. But then the buybacks come online, and they're not having a huge effect, but we are off the lows from 2,600. Well, the point is that we go into the big blackout period, having worked in the corporate sector, in January, which is year end. It's longer and it hits more companies, and I believe that could be the trigger for the next leg down too.
Okay.
Now, my friends on the call, Stylianos included, the Italy EU debacle is another, potential trigger. None of these are black swans because we all know what they are and what their potential effect are. The end of the petrodollar. As the US-Saudi tensions escalate, Saudis are pivoting towards China because China is the biggest buyer of oil in the world today. Who is the biggest competitor?
Of everything.
Of everything, but let's focus on oil.
I interviewed an agricultural lady yesterday, and they're stockpiling wheat and corn like Joseph did in the Bible.
Yeah, and soybeans too. But yeah, I agree. But, the petrodollar is the linchpin for U.S. hegemony in the world. And, to the extent that China is the biggest buyer, who's the biggest competitor to Saudis on the world stage in oil today? Guess
not us.
Exactly.
US. Yeah.
So our best friend is no longer our best friend. And now we've got this, assassination that's causing some, strife between the two of them. And Saudis, they want to make money on oil. The Trump is talking oil down, and Saudis need higher oil prices for higher revenues. So their interests are conflicted as well. So you've got like oil has fallen, over 20% from its peak of what 76.90 down to
What
below
a relentless
Yeah,
market move.
exactly. So this can't make the Saudis happy. What if the Saudis, decide or in an agreement with China, we'll sell to you oil in yuan, and they officially state that they're no longer just going to solely price oil in dollars. That would be a game changer. So that's another catalyst. Then you got emerging market contagion. We all know about that. You got the GE potential bailout. I mean, they've got 110 billion in debt. Can they sell enough assets to pay that off? I don't know. You got potential Deutsche bankruptcy. And then
you're talking about General Electric.
Yes.
Yeah, those smart guys that actually decided to buy back their stock at the recent highs, and now they're like 15 billions under more than they were just because of buying their stock back at the wrong price. I mean, I can't even believe that they still allow buybacks. It's so market distorting. I mean, they're in deep trouble, and what do? They go ahead and spend their own money. I mean, and the pension for unfunded liabilities that they have that they don't have actually, and now they're another 15 billion down because their stock is crashing. I mean, their stock has become literally a penny stock. They kicked it out of the Dow Jones, and last time I checked, last week it was losing every single day like 5-7%. And I think that GE is one of the canaries in the coal mine. Yes. I wanted to ask you, but I didn't want to interrupt you. I totally agree with your interpretation. I also don't believe that such a market move like the one we saw, David, is going to be resolved as soon. So I do believe that there is more. Either we're going to create some type of a triangle here, or we're going to move to a new low. But my question is, what do you think? I mean, seeing already all this weakness spilling off to some of the major sectors, like, for example, mortgage application at multi-year lows, stock of unsold houses, just going up, as fast as possible.
I could answer that. David says we're already in recession several months ago, right, David?
Auto sector moving down. So how do you think, what do you think is going to be the catalyst of another move to new highs before the market actually crashes? Because the only thing that can come to mind to me, but I don't know if it's going to be enough if we make it all the way down to your target, to your C target, is Trump, perhaps, because what Trump did when he came in power is that he tried to keep the bubble going for a little bit longer, this time through fiscal policy, because he knew that the Fed wouldn't play ball any longer. So he cut taxes, he increased spending, and now perhaps he's going to try to broker a deal with the Democrats about like infrastructure spending or whatever. But I'm not even sure that's going to be on time or enough to reverse the situation. I don't know. What do you think?
Well, first of all, I'll say this, Stylianos. I prepare a few Post-its before I get onto these interviews, because I can't remember every bullet point. And you must have like a camera on me somewhere in this room, because my next bullet point was the whole housing market meltdown.
Okay.
So yeah, I agree with you. But the point of listing out those various factors for a catalyst to a crash is just to validate what you were just saying. There are so many shoes to drop here. So I posted a tweet literally yesterday saying, I don't know what the narrative can be to drive stocks higher. The only two items that I can identify right now to be used to push this market higher are the US-China trade war and a softening of relations between the two ahead of the G20 on November 30th. I thought that the market would ignore that because, we've had so many disappointments already, but maybe they're willing to buy it again. But that's one. And the other one was the Fed starts talking dovish ahead of the December 19th FOMC. I didn't think Powell was hawkish yesterday. I felt he was dovish. He made some allusions to the fact that international growth was weaker and the housing market softening. He admitted that it's happening. Those 2 points. Look, the Fed is always optimistic. overly so.
Always. They never predict a recession, ever.
I have to stop myself from bashing the Fed every chance I get, because when I saw Powell use the term extraordinary economy, I knew there was coffee all over the wall in front of me, because it's just ridiculous. If you look at any solid data which can't be manipulated, like the federal tax receipts, as Dale alluded to earlier, they've been in and up and below zero since 2016, and payroll receipts are negative. Yes, exactly. Yeah, they're massaging the data.
At a booming economy, you expect your tax receipts to be increasing, you expect your deficits to be decreasing, etc., etc., and we get the exact opposite, theoretically speaking, in a booming economy. Yeah, right.
Yeah, when I get challenged on that, my quick comment is, tax receipts don't go down when the economy is growing. They don't. They go up. So, and payroll receipts recently have been falling as well. So much for full employment. Yeah, all these guys burger flipping at McDonald's. There's 100 million unemployed in the US. The data, the government statistics are being served up to us in a certain manner to convey a certain narrative, to justify higher interest rates, because they need the ammunition for the coming crash. The Fed has already signaled on multiple occasions that there's a crash coming. They've been at pain since, I think it's about April, May, to take every opportunity to bash Trump's policies, which be it foreign, trade, fiscal, regulatory, immigration, and citing everyone as a potential risk to the economy. And then fast forward to August, and Powell speaks at Jackson Hole, and then in the August FOMC meeting, the first paragraphs of the August FOMC meeting minutes were all about the alternatives to rescue the markets and the economy in the next crisis. What does that tell you? The first thing they talk about is, what are we going to do when the proverbial hits the fan? And then
and we already know from the past, if you remember, and I remember that very vividly because it surprised me, when it was uncertain that we had entered the previous recovery somewhere at 2011 or whatever, I explicitly remember the Fed leaking plans about helicopter money, which tells us that they already knew that quantitative easing would have side effects, and they were already planning, because a lot were afraid that actually the recovery would fail before it took off. So they were already planning at what do we do next, which is, since the trickle-down economics didn't actually work, perhaps we do the exact opposite thing. So we already know that they have in their drawer, several plans about it. But my only question, my only disagreement, because we agree in too many things. I mean, it's it's sometimes it's good to disagree with people because you can have a debate. My only disagreement with you is the following: you said that perhaps a Fed that will turn more dovish is going to help the markets go higher. My only doubt here is the following. The market at the moment, let's say, is showing in good faith that it is believing the success story of the Fed. We did what we had to do, extraordinary measures. We inflated our balance sheet to 4.3 trillion, but don't worry about it because we had an exit plan. We're already executing it, and so far everything seems to be okay. I'm wondering, when the Fed shows that it's about to capitulate, is that actually going to be interpreted by the markets as a bullish signal, or the markets are suddenly going to wake up to the idea that, oh, wait, they will never unwind their balance sheet. They will have to go to the next round of QE. So why do we trust that, this thing is going to work out? I mean, as it seems, our faith that the previous time it would was unfounded. So I'm thinking that perhaps when the Fed capitulates, we're going to get the biggest sell-off, and it also goes contrarily to what the vast majority believes, that which makes me like it even more as a thesis. Now, I don't know what you think about this as a potential outcome.
No, it's a valid one, and I would actually fast forward to, I don't think this is the main crash. This is a 30% drop. It's going to feel painful to a lot of people, but this isn't the big event, in my opinion. As I discussed with Dale back in February, the collapse.
End of next year, isn't it, David?
Well, 2020-21 is the collapse, and it's for the reasons that you outlined, Stylianos. It's that, they have no alternative. What else can they do but print money? There's nothing else these guys can do. So they're going to print on steroids, and the government's going to resort to helicopter money. There's 4 candidates at the next on the Democratic side for the next presidential election that are also already talking about universal income benefits. They have no alternative. So I think the market will take the approach that you did. And initially there will be a euphoric response. Great, more liquidity, yay. And then they'll go, wait, hold on a second. How long are we going to buy this story? It doesn't work anymore. We've seen it. And we're back to it again. Obviously, this doesn't work. And they have no other alternative. So where's the end point? A destruction of the dollar. Well, I don't want to be in U.S. assets if the dollar is going down. So I agree with you further out. But here's the other side of that coin. The Fed put. Powell has been, it's well documented, and a lot of discussion has gone on this, is is Powell going to support the markets? And given the recent downturn, if you think about 2017, we had one-way markets, and pretty much during the Obama era, and that's what Trump was alluding to pre-election. And now we have two-way markets again with a lot of volatility. And actually, the end point I was going to make today is volatility is returned, and it's going to get worse. But we got a lot of volatility. So the market's trying to figure out, is there a Fed put, and where is it? So I think actually, if the Fed were to pause, which I doubt in December, I think they're going to go ahead. But if they pause and reverse, then they will revert to the previous monetary policies, and they'll start cutting rates and start pursuing QE, and the market will respond euphorically. But how long does that euphoria last? I don't know. And that was one of the purposes of QT. It's the Fed's way of saying, look, our policies worked, everything's great. Look, we were able to reduce our balance sheet. We need to do it again. But it worked last time, so let's, it should work again. But the market's not going to buy that the next time around. So I agree with your point, but I don't have as much faith in the markets as you. I think they're going to buy it again. I think it's going to provide liquidity to the markets again. I think the banks are going to use that to buy up stocks again. And then, the rubber hits the road in 2020-21. And the main casualty when we do revert to those policies will be the dollar.
Oh, there's no question about it. There's no question about it. I've said a billion times, I'm so bearish the dollar in the long term. I see no way that the dollar can be bullish in the years to follow. I mean, it can be in the short term. In the short term, it looks fine. But I see no way that they can escape with not completely evaporating the economy without destroying the dollar.
Yeah, David, let's take a look at the linchpin. The dollar really is the key that's, caused the emerging market problems, and, also the yuan gold peg, which you could probably just wait for the yuan to get to the levels you were talking about earlier. And once that top is in, you could buy commodities with both hands.
You could buy everything with both hands except the dollar.
Everything. Okay, stocks, commodities, everything.
Yeah,
okay.
Bonds, the whole kit and caboodle, because when the Fed returns to QE, they're going to be buying bonds. That's why they'll drive down yields. They have to, otherwise the U.S. economy and U.S. budget collapses. They'll prop up stocks too. But
so
yes,
could we do that? Just wait for a sell signal in U.S. dollar yuan, and know when that's happened, the dollar high is most likely in.
Well, that's what I've been pounding the table on this with regard to gold. Everybody's trying to call the bottom in gold and say it's going higher. I've had people, questioning, is the peg still intact? It's not tracking the dollar yuan as much as it used to. Yeah, but the gold was never about just the dollar yuan. As all of you know, from an FX perspective, there are two variables on the right side of that equation, and one is the gold in Chinese yuan terms divided by dollar yuan. So gold in yuan terms rose, but how do I put it? The fact that Chinese yuan is driving the gold price in dollars, where it be against gold directly or against the dollar, has not changed. The equation, it's simple math, remains intact. So if you step back up from the details there, the developments between the US and China on the trade front are the sole driver of gold prices today.
Interesting. Yeah.
And I will get into that on gold. But going back to your point, I've said, I write for Sprott Money now. I've said repeatedly on there that buy when the stock market crashes, because, and when I say that, I mean, I specifically state when it's down 20 to 30%, you can pretty much anticipate that Fed put's going to be exercised, in my opinion. And that is the true peak in the dollar. It may have peaked beforehand, but it's going to send the dollar lower. And the dollar will go down against the Chinese yuan too, because you don't need you don't need tariffs or a trade war to get your trade balance, your trade deficit down, because a weaker dollar will do that for you. So it renders tariffs redundant. There's no need for it anymore. You're going to get a stronger Chinese yuan and a weaker dollar. Hey presto, everything's good. I've been praying for an overnight dollar to yuan devaluation to 740, 780, and everyone's, oh, what'll that, gold will like crash. No, it'll be devalued against gold as well. That's the way devaluations work. It doesn't devalue against the dollar and nothing else. It devalues against the dollar on a daily basis. If I'm talking about an official overnight devaluation, would be ideal if Trump imposes 25% tariffs on all Chinese exports and Chinese come out a week later and say, okay, we've devalued the Chinese yuan 10% overnight. I would remortgage my house 8 times and buy gold at that point, because that would be peak dollar yuan, because it'll cause such global turmoil that the Fed will be forced to reverse policy, and down goes the dollar. So you get a dollar pop instantaneously, and then down goes the dollar. But to answer your point, yes, that is the bottom in gold, and I don't see it yet. I have I don't put any credibility in any of these statements that we're getting publicly about, oh, we're closer to a trade deal, we're close. And then the next day something comes out, oh, no, we're not. We're in, we're out. We're in, we're out.
And the big dollar devaluation, if I may add, David, is what will actually perhaps will save the US indices from collapsing completely in nominal terms, because they will be collapsing in real value, but they won't collapse that much in nominal terms.
Yes, that goes back to Luke Roman.
That's all it was at the beginning of QE. Dollar depreciated 30%. The market was up 30%. Yes,
and that makes sense. I mean, stocks love inflation. But as Luke Roman pointed out, and a fellow Irishman, Louis Curran, it speaks to the Fed's trilemma. When the proverbial hits the fan, the Fed they focus on 3 things. They focus on the stock market, the bond market, and the dollar. Their number 1 priority is the bond market, because the risk-free rate drives everything. If the bond market collapses and yields were to go to 10%, the U.S. government balance sheet, they're toast. There's all this talk about insolvency, yada, yada, yada. Already foreigners aren't buying treasuries. So imagine what happens if interest rates would go dramatically higher. So that's the number 1 priority. Stock market's number 2, and the dollar's number 3. Now, as long as they got this Goldilocks scenario where, they keep the dollar up and they keep stocks up, and bond yields go up, but not, it's manageable, they're fine. But the minute that stocks collapse, because stocks are 150% of GDP in the US, they are one of the primary drivers of federal tax receipts via capital gains and IRA distributions. You can chart this. They need to rescue the stock market. This is why I believe they will come back to rescue. I have no doubt that they will step in. Otherwise, it's complete collapse. And I don't see that just yet. They'll do it again. They'll rescue the market again. So when the time comes and stocks fall, say they fall this 30% to 2,100, Powell turns around and says, okay, we're done reducing the balance sheet. We're going to pause on rates. And then if it continues to fall any further, they'll start cutting, and then they'll revert to QE. The point being, QE will prop up the bond market because they're buying US treasuries because nobody else will. And I believe they're going to likely start buying stocks, just like Bank of Japan has been doing. And that'll drive up the stock market, to your point. But which is the casualty? You only get 2 out of 3. The casualty is the dollar, the global reserve currency. And it'll last for a while, but once the dollar loses its reserve currency status, and it won't be the US voluntarily going, oh, we give up, let's try something else. It'll be the rest of the world going, We don't think so. This doesn't work anymore. Led by the IMF with China and Russia behind them. And that's what China and Russia, this all connects. That's why China and Russia have been loading up on gold for over 10 years now. They know what's coming for the dollar. They know there's just too many problems coming to. You've got the unfunded liabilities that Ray Dalio has been talking about. We don't have a debt to GDP of just north of 100% in the US. It's more like 1,000% when you include the unfunded liabilities. They're waterfalling onto the US balance sheet in 2020.
They're much smaller, but let me add here the contingency liabilities. For example, which would be legal for a company. I know that you're CFA, so you know that very well. Any company has to have contingency liabilities. The US chooses not to do so in its budget, so that is what creates the end result of reporting, let's say, $730 billion of a fiscal year deficit, but at the same fiscal year, they need to borrow 1.2 trillion. What is the rest? Of budget items, right?
Yeah.
Because they don't even include contingencies. I mean, every year they have distractions like fires, hurricanes, but none of that is included in the budget, saying, okay, let's go back 10 years and see on average how much, let's say, we spent on natural disasters. That much. Okay, put it in the budget. You know what I mean?
Yes. But I will say that those numbers are correct because they're not just Ray Dalio, the Congressional Budget Office provided them. Debt to GDP is north of 1,100% when you included unfunded liabilities in the numbers. I can send you the charts, to be honest. So
and they're increasing exponentially by the month.
Yes, exactly. And this is the point. The Chinese and the Russians know what's coming. But my point, what I was coming back to, is the dollar is the linchpin. And when the dollar falls, and I believe it's at least peaked in the short term. It may have peaked already, but there is a risk to 101.16. I was going to get to that later on the Dixie, but it could have peaked already, or it's just a short-term peak. But when the dollar falls, gold rises, and I'm including dollar yuan in that. And there's no need for a trade war. There's no need for tariffs because the U.S. exports will be cheaper in yuan terms, and yuan exports to the U.S. will be more expensive. So dollar yuan can fall at that point, and that's when gold goes higher. But
hey, David, I wanted to ask you in relation to gold. I know you'd advocate to everyone to hold physical.
Yes.
Do you do any work on balance sheets of mining companies to know that, which ones will have survivability during this, last final decline, and who knows how fast it comes back once we bottom? Because you could be right about the gold market and buy a mining company that does reverse splits or goes BK. Do you do due diligence on miners?
I do not. There's only one of me, and I can only spread myself too thin.
Okay.
But what I do, Dale, is I try to use a Ronald Reagan approach, and I'm not a Republican or a Democrat, but I do like his approach, where you find the best people, the experts in various areas. And there's a gentleman called Luis at Economic Alpha on Twitter, who has pointed me in the direction of Kirkland Lake. When it was at, I think, $3-4, and it went to over 20, and
wow.
Also pointed me in the direction of another small company called Wisdom, and I'm up, I think, 40% on that one already. He does due diligence. He meets with the CEOs. He goes to the conferences. I don't know if he's an accountant by trade, but he goes through all of the data, and it's not just me. A lot of people follow him, so he's my guy, if you will.
Okay.
I asked him the same question yesterday.
Yeah, you do intelligence gathering. I know I've been to your Twitter feed, so there are people that, none of us, there's nothing new under the sun. So all of us, we may think that it's an original idea, but maybe it's just a composite of all the things that we read and take in and talk to, and then we have to see it ourselves. So I respect people that respect others' work, and you're right, you can't do it all.
Yeah.
So leave his Twitter handle in my DM box later on, okay?
I will, at Economic Alpha. But I will say this just a quick. Yeah, I like the guys that posted something on this briefly recently. The guys that follow data and a process and never succumb to emotion. So you get a lot of price chasers out there. Gold when we were up at 1240s. Oh, we're going back to 1300. I'm like, no, we're going back down again.
Yeah.
And why? Oh, well, here's the data. Here's why: A, B, C, D, E, and there are several of those around, and you
I'm
have to
thinking
find them.
1120.
1124 is what the number I have on the downside. Yes.
Oh God, here we are. Okay.
Yeah.
So,
So
all right.
let's go back to stocks so we can get through the. I just want to say there are two
No,
other. There are two
don't
other.
you want to talk for another few hours? Steve could ask about 20 more questions of you.
Well, I'm trying.
Steve?
Yeah, well, I want to get as much talk about as much as possible that would be beneficial to you and the listeners. But you know, the other scenario is that we do go to a expanded flat, we go to 3,000 plus. This is the second scenario whereby we never completed wave 3 up, and this is actually the expanded flat of wave 4. We're completing that. We completed that at 2,600, and now we're going back up in wave 5. And I actually prepared this a couple of days ago, so this level has worked out well, 2683. And then once we hit the higher high, then we go lower. This is less. This is not my primary. Yeah, this is not my primary scenario. This is less probable in my opinion, but I throw it out there. If we go to 3,000 plus, it could be the top of wave 3, and then we do our ABC down to 2,100. That obviously would delay the crash. But this is, I'm just throwing it out there.
6 months it would.
Yes. And
into the spring or so.
Yeah, but it is out there. If you look for it, people are talking about this alternative scenario, and it is valid, but I just don't see it right now. And the last one I have on stocks is we just go straight down. We break 2683. We've done our ABC. Our B was right here.
Yeah.
That was your B, and see you later.
61.8 right there to the number.
And then we go. That's alternative number 3, but I just don't think so. I think they're going to come up with another reason to get this market going up again, and then the plug will be pulled, because you've got the buyback with the FOMC on December 19th, the G20 on November 30th, and you got the buyback blackout period coming in January. You've got so many catalysts coming, but that buyback blackout period looks, I mean, given what happened in October, it looks ideal. You get a nice rally on November, December, and then everybody's feeling groovy again, and then whack, January. Or December 19 when the FOMC raises rates again, and maybe they're hawkish, and down we go. But I do see a rally here in the short term, but as Stylianos and Andre were talking about earlier, it has to hold 2683.84, or worst case 2630. Otherwise, it looks like we're going down further. That would be my 2 cents.
Okay.
Now, let me finish by saying, whatever route we take, whether we go straight down, we go up to a new higher high at 3,000 plus, or we hit one of these levels, 2820 again, 2860 or 20, the end point is the same. There's a crash coming. There's no 2 ways about it, in my opinion. Now, I could be wrong, but whatever route you decide to take going up Everest, assuming you get there, it doesn't matter which route you take. It's the point is you get to the same destination, and that's what the situation is. You're going the opposite direction. Is 2,100, 2,200 on the high side in the S&P, in my opinion. So,
okay.
If there's nothing else on that one, let me switch to gold here quickly, and I just want to address a key point, which I've tried to communicate to people on Sprott Money, but the principal driver of gold remains developments in the US-China trade war by way of the Chinese yuan. And I think this is best illustrated here by looking at, I'll look at 2 of these 3, but the reasons why gold rallied on October 11th and November 1st. If you look at these 2, this October 11th rally basically constituted much, if not all, of the rally for the past, since August.
A month. Yeah.
Yes. So what happened on October 11th? The US came out and they said, "Oh, we're going to meet with China again on trade, and we're going to do it at the G20." And the Treasury made a decision not to label China a currency manipulator. Those are the 2 big olive branches the US extended to the Chinese, and everybody jumped all over it, especially gold. Well, what happened the very next? Well, let's look at what happened to dollar Chinese yuan. To illustrate the point, the dollar yuan dumped, which is good for gold.
Right.
And at the same time, the gold in yuan terms rose. That's the perfect combination for gold. Gold in yuan goes up, the numerator, and dollar yuan, the denominator, goes down. So gold and dollar prices goes north. But look what happened the very next day. It started going back up again, the dollar yuan, that is. And the Chinese yuan, yes, we'll get to that. It went up to a peak in October 26th. But the point is that gold got its pop on October 11th, and it went up a bit further based on the it went up a little further based on the continued rise in the gold in yuan terms, but it gave them back again here when we got news that, you know, everything wasn't so great. First of all, the Chinese rebuffed the idea of a meeting under threat of sanctions or tariffs, and that evening they fixed the Chinese yuan at a lower rate against the dollar when everybody expected them to fix it at a higher rate in response to the US olive branches. Well, they did the opposite. So it gradually went higher thanks to gold in yuan terms, but eventually that caught up with it, and we went back down again. And that was driven by the dollar yuan rising again. So fast forward to November 1st. We got news that we had a meeting between Chinese Premier Li and several senators from the US. It was all very nicey. Everybody got along well. You know, China is a great country. We love you guys. And Kudlow then came out in the US at the same time and said, the fact that we're talking about more tariffs doesn't mean that they're necessarily going to be put in place. They're not set in stone. And again, gold went up. November 1st, nice big white candle. Again,
every time I see Larry Kudlow, David, I just have to tell you a story. I interviewed him while I was on FX Street during the campaign phase of the presidential election.
Right.
And I asked him, I said, Larry, what do you think of the Trump candidacy? Do you think he has a chance to win? And he said, nah, he's not doing things right. And now here he is. Isn't that something?
Yeah.
He didn't think he had a shot. Now he's his mouthpiece. It's pretty funny in my mind, anyway.
Well, it is very funny, but I'm trying to stay away from a comment that I want to make on here.
Okay.
In society today, it's amazing how many empty vessels make it to the top. But anyway.
Good one. Oh, I like that. All right.
So then that was on November 1st, and then the next later that evening, this is what we get. Don't expect a trade deal with China at the G20. And again, we're disappointed. And then you get more awful headlines. This one was from Navarro. They muzzled him yesterday, but he still got this one out, where like economic security is, and by the way, this is the truth probably, but they don't want this going out. Economic security is national security. If China stopped stealing IP, it would lose its economic edge. If China undertook structural changes, US asking for it would be existential change for China. He also dismissed the prospects of a deal, accusing China of wanting to tap dance. Conclusion: there will be no breakthrough in the Chum-Chi meeting either in November or any time in the foreseeable future. That is the unvarnished truth. And they muzzled him yesterday because they don't want that going out, because there's no way these two sides can agree. The China want to make China, the greatest country in the world in 2025. The US doesn't like that because they want to make America great again. And these guys are too entrenched. So a resolution will have to be forced on them. And then Pence came out and said this is how, and everybody says that the US is sweating and the US is like going to blow up. They have to agree. I've been saying since day one, US doesn't seem to be like bothered at all. We can do this for as long as we like. We're in it for a protracted war. And when I see these comments from the US, it seems to reinforce that. Pence comes out and says this. After the Chinese are saying they want to, agree to anything or negotiate anything with a knife to their throat. And then Penn says this: the Trump-Xi meeting at G20 may be China's last chance to avoid Cold War II. U.S. is prepared to exert maximum pressure unless Beijing agrees to significant economic, military, and political changes. I mean, do you guys not are they not getting the messages from China that the rest of us are getting? Because this is not going to work. Or maybe they don't want an agreement. Maybe they want this to escalate further. But I think these headlines that we're getting, the positive headlines, are solely designed to prop up stocks. But the reality is, the likelihood of an agreement between the US and China at the G20 in November 30 is small, to put it mildly. And then we have the White House muzzling Navarro because he told the truth. And now we get I was just through this, and this is the latest headlines where oh, look, we're talking, isn't this wonderful? And I gave my comment at the bottom there. Yeah. Another cry wolf scenario. So the point of all this,
Xi doesn't have to run for re-election. People forget that. President Xi does not have to run for re-election in 2 years.
Right. He doesn't. But the Chinese are relying on a stock market crash, and they can literally make one happen overnight. If they devalued the Chinese yuan against the dollar tomorrow, what do you think happens to the S&P 500? It would drop like a lead balloon.
2,100.
So if you know you've got a bazooka pointed at the guy on the other side of the table, you feel pretty comfortable about the negotiations. My point is that gold is still driven by developments between the US and China on the trade front. It drives the rallies and then it drives it lower. The downside, unfortunately for me, why I was one of the few lone people saying that it's going to go lower when we're at the 1240s, is because I don't see any resolution of this until we get a US stock market crash that forces the Fed to reverse policy, whereby the dollar falls against basically everything, including the yuan. When the dollar yuan peaks, gold bottoms. We saw the opposite on April 11th, and now I believe that'll be it. And that's my primary scenario for gold going forward. That's why I agree with you. I think 1124 is the bottom. Just quick comment, dollar index, I believe this is topped, at least in the short term, from a sentiment, technical, and positioning perspective. We could see a pop if there's a stock market crash from a safe haven perspective, but at least in the short term, this goes down, which would prop up stocks, another reason for stocks to go. WTI, love Andre's Fibonacci numbers. I couldn't agree with them more. I see 66, 50% retrace for this.
That would help the market too.
Yes, and just above this previous support level, it'll be a false dawn. We're going down to the 40s, in my opinion, but see a bounce to 66, at least 63. And you can see why. I mean, it's so extreme over bearish. It's bearishness and oversold levels are the same as January 2016. We all know what happened in January 2016. We had the worst January.
We bought it, David, in ForexAnalytix the day before yesterday after this capitulation. I think this last candle down was a capitulation candle. I agree with you. This kind of a move lower definitely will bring more weakness. But I do believe that I don't know if you monitor the DSI, but the DSI actually hit 4.
Yes, I do.
Scale to 0 to 100, we actually hit 4 on the DSI. So it not only oversold on momentum indicators like the RSI, but also sentiment went from extremely bullish like several weeks ago to extremely bearish in such a short period of time, almost 30% down. So I do believe the area I'm looking for in this rebound, I'm still long actually, crude. The area I'm looking for is 63.60 to 64.40. I have a nice confluence of resistances there, so I do believe we can make it there. At least.
Exactly. That's my first target, but I see a possibility of 66, just above this huge support level.
Yeah, absolutely.
And then we go down. But I agree totally with you. And yes, DSI is one of my primary tools. I use a whole bunch of them, technicals, sentiment, positioning, But DSI, it was 4, I think back in, it was either January 6th or January 14 of 2016, it was 4. And back in August 2015 as well. So what tends to happen, as you know, is I love positive divergences for bottoms and negative divergences for tops. We got that in Dixie a couple of days ago when it hit 90, I think it was 91. But I'd love this to go up, back down again to the 40s, but we get a positively divergent low. Because I see when we get this stock market crash, oil's going to go down with it. And you could go down to the 20s even again, but I'd be happy with the 40s or high 30s. But I see triple digits in 2019 when the dollar gets crushed.
Yeah, due to the dollar's crash. No, yeah, there's no question about it. I also believe I would be buying crude near the 40s, both hands. I mean, I would be stockpiling it at my balconies.
Exactly. I'll do what you bought it 2 days ago. I bought it 2 days ago. I bought call options on the USO, but we're in the same boat. And
you could buy the S&Ps right now too, because they went to the number I was looking for, and we're getting a nice reversal candle.
Excellent
confirmation. Yes. So your scenario will, I think, play out, David. What a great interview, because the three of us, great questions. You've been here an hour. Anything you want to add to wrap it up, or?
Yeah, I just want to finish on this one, Dale. The bonds, because Stylianos and Andrea talked to it earlier. I sent a little chat tweet, and I basically wanted to say this. As you can see from my chart, which this is from a few days ago, it's playing out as expected. But I expect bond yields to go back up again, because I think bond yields will peak when stock market rally peaks. And then when the stock, just like in 2008, when the stock market takes a dump, then bond yields go down. Now, in this case, I don't think bond yields go back up again, because when the Fed reverts to QE, which I still think they will, it's just 30% down on the stock market. They're going to buy bonds, and then bond yields go even lower. So I think bonds usually not focused on a lot because they're not sexy, but when this thing bottoms, I see it taking off, and you buy deep out of the money calls for 120. Yeah, 122 or higher out to, you get good prices on them out to June, because I see this going to 130, 140. I see it going sub 2%. Because so
you think we could get one more shot down? That's the way it looks to me, and one more shot up in yields, or the low is in TLT.
One more shot up in yields.
Okay. And 330, 335, 10 years, something like that.
Exactly, 330, 340.
Okay.
And then look out below in yields. Look up.
And then price. You could short the yen when that's done too, right?
You could, but
115.
Short dollar yen, you mean? Yes, I want to buy yen. Yes, yeah, absolutely. Yeah. No, we're on the same page. So that's all that's the last part I wanted to give you. Those are the biggies. I said gold to 111.24, S&P to 2100, 10-year, 30-year down to 2%, maybe lower, 2% handle, and then the Dixie peaked, and I believe it's going down to the 80s and 70s. Dollar yuan is going below 100 again. Dollar yen, and interesting times ahead, and a lot of volatility. There's going to be a lot of you ain't seen nothing yet.
Yeah, what a great time period for traders.
Finally, I was on the snooze button for all of 2017.
Yeah, well, I'm glad. Just like Rip Van Winkle woke up after 20 years. You woke up today to be here with us, David, and really appreciate all of your insights. And people could follow you on Twitter at Global Pro Trader. And that's also David's website, right? www.globalprotrader.com. Correct?
Just add an S.
Oh, traders. Okay.
Yes.
Okay. That's different on the website than it is on your Twitter handle.
Yeah, they wouldn't give me enough characters on Twitter, and I'm only one, unfortunately. I wish I was many, but yes.
So David, thank you so much. I know you're in Canada. I wish you a great holiday season and a prosperous one. And thank you for prepping us, because everything's about having the right mindset so that when these things manifest on our screen, we're not doing the analysis, but we're executing. So thank you very much, David, my trading warrior brother, for coming back to
David. I
F.A.C.E.
enjoyed it as well.
Well, thank you guys. I really appreciate you having me on, Dale. I really love these conversations. And I will say one last comment with regard to what you just said. It's better to prepare earlier than later. And given what's coming, I recommend, I said this with regard to gold, I still think it goes to lower lows, but not much lower. If you don't have any, buy some. At least buy a few silver coins. It's $20 for a 1 ounce coin of silver these days. Buy some.
Thank you, David.
Thanks, guys.
And I have a few coffee cans to fill up myself. So thank you very much, David Brady, my trading warrior brother, one of F.A.C.E.'s favorite guests. Good luck, David. Keep in touch. And I want to thank you again and thank our viewers at investing.com and F.A.C.E. people. And we'll wrap it up tomorrow with TGIF. And remember, even if you catch all these swings, don't just count your pips, count your blessings. And we'll see everyone tomorrow to wrap up the week. Adios, and thank you again, David.
Thanks, Dale. Thanks, Julianos.
Thank you, mate. Bye-bye.
Thank you for your help today, Steve.
It's a pleasure.